Hello, everyone. Looks like we're live. You have Akshay here from Shining Star Funding. We have Deepak here from Shining Star Funding as well. And we're very honored to have John Goralka here with us again to present our third estate planning module. John, you want to just take it away from here?
Sure. Thank you. I can't see any faces here, so I guess I'm on. But thank you for having me. My name is John Goralka. I'm the founder of the Goralka Law Firm. Today, we're going to be talking about property tax planning for the real estate investor. And as you all know, Proposition 19 took away a lot of the benefits of the parent-child exclusion. But we'll be talking about how that changed. And then if you stay through to the end of the presentation, we'll be talking about how you can acquire a real property in California, own that, and then sell that to a third party and have that third party acquire the real property with the historic property tax base, meaning the property tax would not be reassessed. So again, if you're selling a piece of property and your property has more favorable property tax characteristics, that will enhance the value of that property. And we'll go through that in a great deal of detail. As Deepak and Akhtar indicated, my name is John Goralka. I'm a certified specialist in taxation, and I'm also a certified specialist in estate planning, trusts, and probate. I'm only one of the very few attorneys, about 100 in the state of California, that have both of these specializations. My background before I was an attorney is I was an income tax auditor. So what that means is with all of those attorney jokes that you hear, nobody was ever happy to see me when I came to audit them. We actually have an awful lot of information that we're going to try and pack in a short period of time. And truth be told, the very best part of the information is coming at the end. So we'll try and get there as we can here. First, Proposition 19, just a little bit of an overview. It passed with an overwhelming majority of 51.1%. Yes, that's sarcasm. And I do believe many people that voted for that really did not understand really what that meant. Proposition 19 was described as providing tax dollars that will go for wildfire response. Lord knows we've certainly needed that in years past. And so that is really a large part of what it was described. It also got to deal with allowing homeowners age 55 and older to transfer property tax base. Many people did not understand that it restricted and in many ways virtually eliminated what we have known for many, many years as a parent-child exclusion for property tax purposes. And that's going to affect each of you and also will affect your estate plans in many different ways. A little bit of trivia. Proposition 19 was actually not put forth by the state, was not put forth by the county assessor's office, but was actually put forth by the California Association of Realtors. Presumably that's to increase sales. The virtual elimination of the parent-child exclusion will certainly increase sales volume. It does have an effect on California's tax base. California's taxes historically have roughly been deriving 2/3 of its revenue from income tax paid by 35,000 wealthy residents. And so because of that, California's income stream has been vulnerable to variations, primarily due to changes in the stock market and perhaps more recently with some of the changes in the tax laws with many wealthy residents leaving, and probably the most public of those was Elon Musk. Interesting thing about Elon Musk is while he moved and changed his residence, he actually still increased the production at his Fremont facility here in California, so he didn't fully move away. Proposition 19 brings more changes in ownership, will result in more assessments, and will result in generally higher property tax revenue. What we need to understand is the definition of a change in ownership is different for income tax purposes than for property tax purposes. And first, just a few notes about what we lost. Revenue and Taxation Code Section 63.1 provides that a change in ownership does not occur unless if there's a transfer of property, real property between parents and children of either a principal residence or the first $1 million of trended base year value. That's a fancy word for saying the historic property tax base, which is you will be able to see on each of your property tax bills. That was the old rule. And so as a result of this change, we need to be very careful, and in fact increases the need for revocable trust or just basic trust planning. In the past, we didn't worry about a change in ownership on the death of a parent, and we were maybe lax or casual or not in a real rush to sell the parent's home because we had some time because of the parent-child exclusion. That will no longer be the case. And then, as I say, the exclusion was provided for the principal residence of any value. So, for example, if your residence had the same value as Hearst Castle, that would be able to pass from one child to the next, from one generation to the next, no change in ownership. The $1 million of trended base year value, if you've not had a change in ownership, there are limitations, to approximately 2% increase in value. So what that means is we have a lot of properties that have very low property tax basis. So we're going to be seeing a number of changes. Here we're going to try and give you a few investment tips as we go along. Here we have Malcolm Forbes, who indicates that he made his money the old-fashioned way, and he was just very wealthy, very nice to a wealthy relative right before he passed away. Parent-child exclusion. So really, what are we talking about? And the best way to do that is really go through some examples. Here we have a mother who transfers 100% of Blackacre to a child, and Blackacre is mom's residence. It has an assessed value of $3.5 million. Property tax, when you're estimating property taxes, it's usually going to be between 1 and 1.2% of the value. So if we have a $3.5 million property, 1% of that, which is an easy thing to estimate, gives you a $35 million or $35,000 annual tax bill. If the fair market value is now $8 million, that means that the property tax is reassessed, it's going to go up to $80,000 annually. And the wonderful thing about property tax, remember, is the tax that you keep paying each and every year that you own the property. Here we transfer this property that has an assessed value of $3.5 million to the child, has an $8 million value. There's no reassessments, and so now that child is going to be saving, roughly $45,000 in property taxes each and every year. So you can see the numbers here are really substantial. And another example is here we have mom transfers 100% of Blackacre to their child. Blackacre is not the principal residence. The assessed value is $350,000. So remember, 1% of that as an estimate would be a $3,500 property tax bill. Fair market value is now $1.2 million. So the property tax would increase to $12,000 a year. And here it's not the principal residence, but it is underneath the $1 million of trended base year value. So there's no reassessment. And so now that child is going to be saving, significant amount, almost $10,000 in property taxes each and every year they say that they own the property. And so really, what are we talking about? And now what we're talking about, the parent-child exclusion is now going to be limited. And this is for any transfers after February 16th, 2021. For folks on here that may be selling properties or dealing with probate estates, if the death occurred before February 16th, then the old rules apply. So that would be a wonderful thing for that family to be aware of. If the death happens after February 16th, the new rules apply. And now under the new rules, for the parent-child exclusion to work, it has to be the principal residence, number one. Number two, the child must actually use it as his or her principal residence. Under the old rules, there was no such requirement. And then what's not indicated on the slide here is if that child ever stops using it as their principal residence, then it will be reassessed to the fair market value as of the date of the transfer. And then second, the limit is no longer, the amount is no longer unlimited. It is now limited to the home's base year value plus $1 million, which would be adjusted. So again, this is a very significant limitation on what we've had before, both in the numbers and in the individuals that would qualify, meaning the children or child must actually use it as their principal residence. And then also the exclusion no longer qualifies at all for any property other than a principal residence. So again, huge change. And then moving on, we need to think about Proposition 19 is just a reminder, and that there are other planning opportunities that are available and can still be used. And so now is when it's going to be important for you, and these are things you can do to help yourself or help your clients. And at the outset, I talked about how you can acquire a property and sell that with those favorable property tax characteristics. And where you can find an outline, the best outline for that, and we, Deepak posted this for you to look at along with copies of the slides. For the case is Ocean Avenue LLC versus County of Los Angeles. And here Michael Dell and his family and two investors acquired the Fairmont Miramar Hotel in Santa Monica for $200 million without any reassessment of property tax. They enjoyed an annual savings of $1 million. This transfer was challenged at appeal. Not only did Michael Dell prevail, but he recovered $252,000 in his legal fees. And the reason why is because he stuck to the statutory requirements step by step, and because the county was trying to assess or trying to attack that. They were treating that as attacking the constitutional provisions, and so they owed his fees when they lost the appeal. So this case really gives you an outline of what you can do to repeat the same. And here, Michael Dell effectively acquired 48%. Michael Dell's wife, repeat wife, not ex-wife, acquired 49% in a separate property trust. Two other outsiders joined in. You'll see the reference to the case there, and that is the site. And so because they were able to stay within the rules, they were able to acquire the property without a reassessment. The real trick to this is that the persons that were selling the property to the Dells acquired the property directly in an LLC. If you get nothing else out of this presentation, if there's only one thing that you remember, if you are acquiring property with an eye for property tax savings, you don't want to acquire it in your name and then put it into an LLC, as most people do. You want to acquire it directly into an LLC. We'll go into that a little bit more as we go along. Historically, 2002, Ernest and Julio Gallo purchased Louis M. Martini's winery, which included 1,000 acres of prime Napa and Sonoma vineyards. None of that property was reassessed. That land continues to have its property tax base of 1975 of a few thousand an acre, whereas it's probably worth significantly over 150,000 an acre now. Careful planning is required when the property is first acquired. And again, here you'll see that highlighted: acquire the property directly into the LLC. If you acquire it in your name individually and then put it into the LLC, there are some things that you can do. We'll talk about that in a moment. But the property is not nearly as susceptible to this type of planning. And really, you may want to look at as property that is acquired individually has a taint on it. And so let's go through the rules a little bit. Proposition 13 provided for limited annual increases unless there's a change in ownership, not to exceed 2% per year. That's the term trended base year value. You're going to see that on the property tax bills. And so there's no reassessment unless there's a change in ownership or completion of new construction. And the other thing that you need to keep in mind is there are three elements to a change in ownership for property tax purposes, different than income tax. And here we're looking at Revenue and Taxation Code Section 60. And there are three elements: the transfer of a present real property interest, including the beneficial use thereof, and the value of that interest must be substantially equal to the fee. And here, the safest way to double your money I have found is to fold it over and put it in your pocket. And so here, moving on, we want to, as a lawyer, we're always very concerned about malpractice, making a mistake. And so this is something that you're going to want to keep in mind for yourselves and for your clients as you move into this area. This area, as you can probably tell, is not subject to common sense or logic. That does not apply. These are all very specific, detail-oriented rules. And the key is you want to make sure you dot the I's and cross the T's and be certain about what you're doing. And so the first thing you want to try and do is avoid non-proportional transfers. And here, the best thing I think to do in terms of understanding that is getting an example. And one example would be husband and wife own Black Acre as community property. For asset protection purposes, husband and wife transfer Black Acre to a family limited partnership owned 99% by husband and wife as community property. The problem with limited partnerships is the general partner. the general partner is still primarily liable. So what happens is many times the general partnership interest is owned by a corporation, and indeed that's what happens here. The only problem is it's a corporation that is owned by husband, wife, and daughter. And now we no longer have a proportional transfer because it's not just husband and wife, and so not just the 1% of the change, the entire property is reassessed. And truth be told, you can get to the same result. We could have formed it so that it's owned 99% as limited partners by husband and wife. They could have formed it with a corporation owned by husband and wife, and then just gifted another percentage to the daughter after the property was acquired. So again, that horrible, ugly M word or malpractice word looms big. So we need to be very careful about that. And so really, what does the code say? Revenue and Taxation Code Section 62A2 provides that any transfer between an individual or individuals and a legal entity or between legal entity that results solely in a change in the method of holding title to real property in which a proportional ownership interests of the transfers or the transferees remain the same. So that is a mouthful, isn't it? But really, common sense tells you what's going on. We have property that's owned by husband and wife before. We transfer that into an entity or entities plural that is owned by who? Husband and wife in the same percentages of ownership. And so because of that, we have proportional transfers. It's really more of a change in the form of ownership, and the beneficial ownership remains the same. So that's really the concept that we're looking at with respect to proportional transfers. And so here there's another example. We have husband transmutes. Transmutes is a fancy word just for changing separate property into community property. So now husband owns property as separate property. He changes that ownership to community property, and now he transfers that to he and his wife. Both own 50-50. No change in ownership because they're owned 50-50. But what if he did not do that transmutation? If husband owned it as is separate property, then transferred it to an entity owned by husband and wife, now we no longer have that proportional transfer, and so we've triggered a problem. And here, Bob Hope is a bank is a place that will lend you money if you can't prove that you don't need it, and I think that's certainly true nowadays. Moving on now, Revenue and Taxation Code Section 64C provides that a change in ownership occurs when a person obtains control of more than 50% of the voting stock of a company or more than 50% of the legal ownership. So now we have a change in effective control, so that the change now somebody has changed to getting more than 50%. So what's an example of that? We have an LLC owned by 90% by mom, 10% by son. LLC purchases Blackacre. Mom dies and leaves 50% of her interest to her son, and then 50% of her interest to her daughter. 100% reassessment. Why is that? Because now son has control. He already had 10%, gets 45%, boom. And so what might we have done? We might have wanted to adjust her estate plan to make sure that we still had a proportional transfer. So again, we're going to want to be very careful, and we're going to want to track that. And indeed, you're going to want to be tracking the control and the voting percentages on any LLC before you're doing any gifting or transfers, because you want to make sure that you're not going to be triggering a reassessment of the property for property tax purposes. Here, another entity transfer. We have LLC is owned 100% by mom. LLC, repeat, LLC purchases the Blackacre. Why is that important? It's because that avoids the taint. Mom dies, leaves 100% of her interest to her child. 100% reassessment because the child owns more than 50%. What might we have done? We might have 50% go to the son, 50% maybe go to a trust for another family member, or maybe for the son's children. So again, without careful planning, we can trigger hugely unexpected results. Here we have an LLC is owned 90% by mom, 10% by son. LLC purchases Blackacre. Mom dies and leaves 50% of her interest to daughter, 44% to son, 6% to daughter-in-law, or mom could structure it so that son and daughter each end up with 50% of the LLC, no change in ownership. So again, we want to make sure we're doing this type of planning and we're doing it correctly. Mom owns 100% of the LLC and has only one child. The LLC purchases Blackacre. Mom dies and leaves 50% to son, 50% to daughter, or 50% to son, 50% to grandchildren. We all know the answer. That's a proportional transfer. We have not given anybody more than 50% ownership. So again, no change in ownership, no reassessment. Again, here another thought for the day. So now we're getting into the area that I really want you to remember: the taint. Revenue and Taxation Code section 64D provides that if property was transferred to a legal entity, then in addition to the one person obtaining control, the 64C rule that we were talking about, there is also a change in ownership if more than 50% of the original co-owner's interests are cumulatively, and if you have a pen, I would circle the word cumulatively transferred. So what does that mean? We have to keep a history of all the transfers, and indeed we do that for the limited partnerships and LLCs that we are overseeing, to make sure that we don't inadvertently have a transfer of ownership. And so here, mom owns 100% of Blackacre. Mom puts Blackacre in an LLC. She owns 100% of that. And what does that tell you? We have the taint, right? Mom owned it. She put it into Blackacre. Mom dies and leaves 50% of the LLC to son, 50% to the daughter. We have a transfer of ownership. Why is that? Because now more than 50% of the original co-owners were cumulatively transferred. Mom died. So again, that is why we want to avoid the taint. And remember, we are talking about our friend Mr. Dell and his family in that acquisition. The same is true there. So that's why it's so very important that the original acquisition be made directly into an LLC. And so again, here, husband and wife transfer Blackacre to the LLC. LLC is owned 50-50 by husband and wife, and we do have the dreaded taint. Husband dies, leaves 50% of his interest to son, who gets 25%, and then the remainder to daughter, 25%. Son now transfers 5% to wife, transfers 5% to son. We have a change in ownership because more than 50% of the original co-owners, remember, the original co-owners transferred their interest. And so now moving on, we have another example where the LLC is owned by husband 50%, wife by 50%. Again, we have that dreaded taint. Husband transfers 50% interest to son, which is 25%, and daughter 25% also. Son transfers 5% to a friend. No change in ownership yet, because you only count the original transfers once. Not more than 50% of the original co-owner's interests were transferred. So once again, common sense logic just does not simply work. We need to be very careful as we move through this area. And now we have an LLC owned by husband 25%, wife 25%, daughter 25%, son 25%. Husband dies and leaves 25% to wife. Son dies and transfers 25% to a friend. Daughter dies, transfers 25% to a friend. No change in ownership. The interspousal don't count. Interspousal transfers will not count towards that 50%. So then here we have an LLC owned by husband 50%, son number 1 20%, son number 2 20%, and daughter 10%. Husband dies, and it probably shouldn't be appropriate to be doing compound percentages or fractions after the lunch period. But in any event, husband dies and transfers 5% to son, 5% to son 2, 40% to daughter. No change in ownership whatsoever. But as it's highlighted there, any person, if they transfer 0.1% or 0.001%, transfers any interest to any other person, now we're going to trigger a change in ownership. Here we're right at the 50%. So again, we want to be careful. When we're doing our planning, we want to make sure that we build in that cushion. Remember the Dell family. Remember how we had 48%, 49%. We have the two other investors. That is why they were doing that, to give the longevity to what is going on, so that way they can stay underneath that 50% number. And here, money is like manure. You have to spread it around. I think there is some truth to that in today's world. So the reporting requirements, this is huge. And for those of you that are ever acting as a successor trustee, or if you're assisting a client in that regard, if there's a change in ownership by a legal entity, that legal entity must report that change in ownership within 90 days. And this rule actually came from our interim governor before, Mr. Schwarzenegger, and there is a penalty that is that there is no reasonable cause exception to that. If you fail to report that, there is a penalty that is applied in addition to the change in ownership. So this is really a trap, because many times if there's a death, you may not even know that your client or your family member had an LLC, let alone that it owned the property within 90 days. And there is no reasonable cause exception. So again, that's something you want to look at. And if you're working with folks that are dealing with probates or dealing with even trust administrations, you're going to want to make sure that we track this, because we want to make sure that we don't miss that. And so what do we do after February 16th? And so this is here, parents can transfer property directly to an LLC, not to the children, no reassessment. Once it's in the LLC, now that parents can transfer 50% to a child or children, no reassessment. We're going to want to make sure that we report the gift. We're going to want to make sure that we're going to do a gift tax return, even if we are not worried about estate tax. We're going to want to make sure that we can do a gift tax return. We may want to wait a year or so, or maybe more. We can terminate that LLC, distribute the property back out in a proportional manner, 50% to the parents, 50% to the children. And now we form a new LLC with the parents remaining 50%. And now we go through that again. And now just within 2 rounds of that, we've got 75% transferred. So we want to repeat that as necessary. Children can create their own LLCs to pass those interests on. But again, we're going to want to be very, very careful about that. Here is sort of a diagram of what we're talking about. But we want to worry about something that's called the step transaction doctrine. And what that is a doctrine that can be used by governmental agencies, including the IRS, and certainly by the counties with these reassessments. And the counties are much more sophisticated than they used to be. I have had them assert that doctrine with me in the Tahoe area when we were dealing with transfers of condominiums, which are really condominiums for boats. But again, and what the step transaction doctrine says is if we have a lot of small steps that happen too closely in time, they can actually avoid those intervening steps, because the end result was the transfer from the parent to the children, and collapse those and make it a taxable transaction. So that's why we want to make sure that we have sufficient time between the initial funding of the LLC, between the transfer of the properties out of the LLC, the termination of the LLC, and you can't transfer them back into the same LLC. It has to be an entirely new LLC. We're going to want to make sure that we do each and every step that we would do for a normal gift, even if it's not worried about estate tax. And the reason why is we want to be able to show this to the county if they attack, because we can show that we have followed all the appropriate steps for a gift tax return. We're going to want to have appraisals, all of those things. When you form your LLCs, when you're doing those with these properties, you are going to want to choose to be taxed as a partnership and file that partnership tax return, even if perhaps it's zeros. We're going to want to do everything we can do to everything that we can do in order to support the legitimacy and the appropriateness of the LLC funding that we had. If we are picking up and now we have this lower property tax base, we may be able to use 1031s. There's a whole host of things that can be done to avoid capital gains. That's something we can talk about in a separate presentation. 1031s is one area to do that. And there are certain other tools that can be used as well. Sometimes there's even some rules under the basis shifting to where we have a low basis asset and by acquiring another high basis asset and then having distributions out in kind can significantly reduce the income tax to pick that up when we have the ultimate sale. So I know I talked really, really fast, but we had an awful lot of information to try and get through. The key thing to remember is you're going to want to make sure that you're acquiring properties within an LLC directly. And then secondly, if it's treated properly and the buyers acquiring that property structure it properly, it's possible for you to sell that property to an unrelated third party and keep that historically low property tax base, which is a favorable tax characteristic, which will add to the value of the property that you're selling. And with that, I'll go ahead and thank you. And if anybody has any questions, I can go ahead and take those now.
John, there's a question about cumulative transfers, you referred to cumulative transfers. Um, I believe you were trying to say those cumulative transfers do not apply if the transfers are from the individuals to the LLCs. Can you explain a little more about that?
What does exactly the question say?
The
So,
question is saying that you're referring to cumulative transfers, and cumulative transfers, does that mean that a person, the husband and wife, cannot transfer more than 50% of their ownership, or will it count as us?
so again, that only comes up with the taint. So if the property is acquired directly by the LLC, then we don't have to worry about the cumulative transfer of the
Gotcha.
historic owners. And then if it is acquired with that taint, they can still transfer it, but when they transfer more than 50% of the original co-owner's interest, then the
Mhm.
property tax is reassessed. So again, that really underscores why planning is needed from the very, very beginning.
Thank you. There's one more question about reassessment, and they want to clarify what you mean by reassessment plus $1 million. What does that mean?
So I believe what they're talking about is under the rules now, under the old rules before February 16th, or if they have a death of a property of an owner of a property, if you have a death of an owner of a property that occurs February 15th and earlier, then the value of the residence is unlimited. And also, we have it under the old rules. You were allowed to transfer acreage, commercial properties, any other real property, so long as it did not have a a value in excess of $1 million on the historic rules. Under the new rules, starting February 16th, with a home, you're limited to the base year value plus $1 million. And so let's say, Deepak, and I do understand you're living at Hearst Castle now, and so you transfer Hearst Castle to your son. And so now, what would end up happening is let's say Hearst Castle is worth 100 million. We have the base year value plus 1 million. So then we would have a split assessment. So the first $1 million worth of value plus the base value would not be reassessed, but the value over and above that would be reassessed. And so that's really how that $1 million number comes to play.
So if the current value is $2 million assessment value, how would that take place? Would it be assessed at 3 million now, or?
So what would happen is if the value of the property and we're talking about a principal residence, there's no parent-child exclusion for anything but the principal residence. But for the principal residence, if the historic base year value was 100,000, and now we've transferred that, and the real value of it is 2 million, so we would have the 100,000 plus the $1 million over it, so we will be reassessed for the 900,000 up to the $2 million number at somewhere between 1 and 1.2% annually.
So the new value would be 100,000 plus how much?
The new value, you're looking at the value would be the reassessment would be calculated on the amount over the base year value of 100,000 plus the $1 million cap, and so then we have 900,000 that will be over and above that. So we will be paying tax on that $900,000 number.
Gotcha. And if the value already was $2 million, then there would be no $1 million cap. Let's say the value is $2 million.
It's 1 million over and above what the trended base year value is. So it's
3 million
historic value, right? So it's
Then it
pretty
would
rare
go
that
to
you're going to have equal to the historic value, because that means you're buying it and selling it within a very short period of time.
Gotcha. Akshay, do you see any other questions?
Those are all the ones I see for now. But as always, we'll accumulate the questions, we'll consolidate them, and John will get back to you.
If anybody has any questions, and we have a copy of the case that is on the site, we also have the slides for notes that were posted. And if anybody has any questions, feel free to reach out.
Excellent.
Okay.
Thank you.
Thank you all. It's nice seeing you both.
Yeah, you too. Thanks so much, John.
Bye.
Bye.